Hold on, wait. Tom Lee has recommended 5 new stocks in some of the best sectors to take advantage of in the upcoming V-shaped recovery of the stock market. Stay up to the end of this video and I will give you all 5 stocks and what strategy would work best with Bitcoin to make a ton of money. Here's a clip of Tom Lee going a little bit more in depth.
Joining us now is Fundstrat Global Advisors Head of Research, Tom Lee, also a CNBC contributor. I think you're in like a studio, so you can't run like an actual victory lap, and maybe you're not there to do it yet. But Tom, what did you see that apparently so many others miss? Because I thought we were going to zero.
Well, and zero is always a possibility, Brian, but I think it comes down to 3 things. The first is the high yield market never confirmed the panic that we were seeing from the economists about the economy. High yield spreads did widen to like 439 basis points wide. But if we were barreling into a recession, they'd get to 700 or so, and they're back down to like 360. The second is that the stock market did have a liquidation event, as you point out, but waterfall declines, all of them, 17 out of 18 since 1950, had a V-shaped recovery. So we knew that whenever the bottom was established, the bottom would be a V-shape. 2022 was the only real exception because of Jackson Hole. And the third is we had a lot of faith in businesses. These companies have been battle tested. They survived a pandemic shutdown. They survived a bullwhip effect from a recovery. They survived the fastest rate hikes in history. So I think that businesses really should get credit, and they've delivered earnings even for Q1 and for guidance that have been way better given the Armageddon that we expected. So I think those 3 things are the reasons we sort of told our clients to kind of buckle down and even add exposure.
I did something I almost never do, Kelly, which is I deleted a tweet. Because I tweeted out around that time, I was like, you're not really losing money
thinking about that tweet
until you sell. And I meant it.
Left it up.
No, I should have. But I meant it, Tom, as a reference to this show that I was listening to on another network where they said retirees are being wiped out. And I was frustrated. I tweeted out, people got a hold of it, and it took this life itself. But my point was that unless you're retiring in a few months or a year or whatever, or you're 80 years old, whatever it might be, you don't it's better to be in the market for a long time than to try to time the market, correct? Like if you're a trader, hedge fund, that's one thing. But if you're a longer term investor with a timeline of more than 5 years, the bias is clearly to the upside. But I think because the sell-off was so politically oriented that it kind of took on a life of its own. Would you agree with that?
Yeah. I mean, there's a couple of factors at work. We were highlighting it during the tariff dislocation, but we know that the equity professional universe of investors, looking at political surveys, more than 60% are Democratic leaning. So their interpretation of the actions of the White House was half empty. So we saw an exaggerated move in equities relative to the bond market, where in the bond market it actually is flipped. In the fixed income world, 60% of bond managers are registered Republicans. And so that's why I think you get better signal, at least in this instance, from what the bond market was doing. And the second is, of course, something people have talked about is the 10 best days. We were highlighting this multiple times that if you exclude the 10 best days of 2023 or the 10 best days of 2024, the S&P only returned 3% a year each of those years. So you need to stay in the market, as you point out, in order to get the 20% gains. And I think this year is another example of people rage sold at 48.35, and now they're buying in today. They missed 1,000 points or 20 percentage points of a gain in 2025.
Do you have any thoughts on kind of bond yields at these levels? Does it matter? I mean, just kind of picking up on what we were just discussing. And for those who missed and wish that they had piled in at the lows now a month ago, what do you say now? That no one now wants to go, all right, fine, I'm going to make my move now, and now stocks are back at the highs. Maybe we then slide lower again. So just some kind of general advice.
Yeah, I've got a couple of pieces of advice. I mean, right now, the 10-year yield at 4%, I think isn't a huge burden for not only for the government, but also for the economy or for companies. So I think it's a level of funding that businesses can earn a return on capital. And then as we think about 2026, there's a lot to be excited about. We have deregulation coming. We have the tariff debacle behind us. We have tax cuts possibly. And then we might have better trade partnerships with other countries, meaning U.S. companies have earnings upside. I think that the market is flat year to date through May. So I don't think anyone should feel like they missed anything. I think that they're going to have a chance to buy a lot of companies. A lot of stocks got obliterated. And I think that these washed out names are still opportunities. And we talk about it with our clients, whether it's Tesla or the Mag 7 or the small caps, there's many opportunities still.
Now, I will show you a deep analysis of the past week by Tom Lee and some of his recommendations.
This is the update for the week of May 9th. There's a lot to cover in this video because I do want to talk about macro as well as the rebalance of the Granny Shots ETF. First, some particulars. As of May 9th, the price was $19.81, net asset value of $19.80, and total assets of $983 million. Over the past week, Granny Shots celebrated its 6th birthday, and we are pleased to announce that during that week, assets for Granny Shots surpassed $1 billion. So thank you for all your support. For the week of May 9th, Granny Shots gained 0.66%, both on price at NAV. The S&P was down 0.45% for relative outperformance of 108 basis points. Year to date, Granny Shots is outperforming the S&P 500 by 252 basis points. But what's notable is the dip here you could see in the months of February and March of relative underperformance. That's because of a black swan event that occurred in markets. And it's actually not this black swan, but it's the black swan as referred to by Nassim Taleb. In 2025, there were 3 things that contributed to this black swan. The first was the drug tariffs announced on China to Canada and Mexico. The second one was the DeepSeek and the sort of disruption and fears that this would really undermine US AI efforts. And the third was, of course, Tariff Liberation Day on April 2nd. What all this contributed to was a waterfall decline in the S&P 500. And in fact, it was such a significant decline that the Black Swan Hedge Fund, which is actually the lead scientific advisor there is Nassim Taleb, gained 100%. And the last time this Black Swan Hedge Fund had strong performance was COVID. So we know there was a Black Swan event. And yet the markets managed to stage a V-shaped recovery. Yeah, it was a symmetric recovery. Now, it is something we talked about in past videos, that when you have a waterfall decline, almost every waterfall decline has a symmetric V-shaped recovery. But there's 5 reasons for this, and these are not in any particular order, but this is why I think markets recovered so quickly. I think investors made a few mistakes. The first was they were betting on the end of US exceptionalism, that their view was with DeepSeek and the tariff wars, that the rest of the world would start to be a better place to invest. But keep in mind, if you look at the 25 largest stocks in the world, 21 are US companies, only 4 are non-US. And here's the question. Do we really think that the tariff wars, maybe monetary policy, are enough to unseat the US center of innovation? That's not our view. The second is many thought the US was going to slip into a recession, so they sold US stocks. But as you know, we've talked about this, the high yield market did not confirm that. The high yield market, as you can see here, this is spreads, have been rallying. In fact, at the peak, high yield spreads only got to 461 basis points wide to treasuries. Here's some perspective. If you look at the last 15 years, high yield spreads have gotten even wider than that. And only one of them led to a recession, which was the COVID period. And that was 1,000 basis points wide. And even when the Fed was doing the fastest rate cycles in history, the widest it ever got was to 599 wide. And again, that's why we did not say there was a recession risk, because that's not really a recession level widening. And in the post-tariff liberation day carnage, spreads only got to 461 wide. In fact, as you know, many economists have now canceled their recession call. Like, for instance, JP Morgan just this past week said there's no more recession risk. The third is that people said the supply chain was going to take a hit, so they want to short US stocks. Well, we've talked about this too, that look, let's say container bookings are taking the shape. These are ships leaving from China to the US and they collapsed, but they're going to recover now that we have some tariff visibility. markets are going to ignore that because that's a speed bump that works its way through the supply chain, similar to a government shutdown. And in fact, even though that's our view, hedge funds were shorting cyclicals and small caps, and they continue to short them even this past week. Well, guess what? Container bookings have exploded. So now that we have the tariff wars behind us, things are recovering. The fourth is that the VIX surged, and that forces institutions to de-risk. The top chart here is the VIX, and the bottom chart is speculative positioning that's non-commercial. Okay, that means in other words risk on. And as you can see, every time the VIX spiked, everyone is forced to de-risk. Well, guess what? When VIX starts to calm down, people re-risk, and that causes a rise in stocks. And lastly, and I congratulate this, retail investors were buying this dip, but hedge funds typically short what retail does. So you basically had retail buying while hedge funds were shorting retail actions. But guess what? Retail got it right. And of course, ultimately, this is a reminder, and we've said this before, there is a Trump put out there, and investors just forgot it. A lot of people said the Trump put didn't exist, but that's not true. So where does this lead us? I think the S&P is going to make its way to all-time highs and probably go higher. We cover that at FS Insight, our service for investors to follow our views. But again, we do think at least making it to the all-time highs is very likely. And that gets us back to the granny shot. So granny shot suffered during this black swan period, but as you can see, in April and May has begun to recover. In fact, it gained 771 basis points relative to the S&P since May 9th. And therefore, it leads us to our quarterly rebalance. So we are rebalancing granny shots after a black swan event. So let's talk about style tilt. Well, it turns out we still want to stick with the same two style tilts, growth cyclicals and growth quality. But in terms of seasonality, these are the 8 most attractive groups over the next 3 months. Tech hardware, software, interactive media, beverages, broadline retails, healthcare providers, healthcare equipment supplies, and tobacco. Although I got to tell you, healthcare, I think, is a little dangerous. So we might want to de-emphasize the seasonality there. That means we have a couple of deletions. We are deleting Accenture and Qualcomm due to this quarterly rebalance, but we're adding 5 stocks. So we have a net 3 gain. So let's go over these stocks. The first is FICO. Now, if you're not familiar with FICO, I mean, this is the price history over the past 6 months. It's a very good looking price gain, and it's led by William Lansing as a CEO. But in short, FICO is a central player in the growing need for quality information security. They do a lot of things in fintech, but of course we know them for their ratings and credit ratings for individuals. The second is GE Aerospace. And this is an old line company. It's being added because of style tilt. And Larry Culp has been the CEO for 7 years. But I think the best way to think of it is GE is going to be a central player in the growing need for quality sovereign border security. And we talk about energy and cybersecurity. This is, again, an important player because they make a lot of things that the US wants to build here. The third is Robinhood. And as you can see, Robinhood is really qualifying because it's now part of style tilt. And it has been in the millennial list. But the reason we can finally add it as a granny shot is that it was added to the FTSE All World Index, which is a major index, on March 22nd. So it didn't meet eligibility criteria previous to this. Robinhood, of course, has been a very good performing stock. As you can see, this is year to date, led by its founder. But the simple way to think of Robinhood is that it's the millennial blue chip financial services company. I don't want to say it's the Goldman Sachs, maybe it's the Morgan Stanley, maybe it's the JP Morgan, but it is really the blue chip company because they're doing all things for millennials. The fourth is KLA-Tencor. Now, KLA-Tencor is a semiconductor company. They have a longtime CEO, Rick Wallace. But the way to think of it is KLA is a key player in the AI future. And again, it meets eligibility criteria because of the style tilt that we're making. And the last one is Monster Beverage. You've all heard of this company, hopefully. It has a co-CEO who's been there for 35 years. It's been one of the best performing stocks in the S&P 500 really for the last 20 years. But the best way to think of this is that it's the leading functional drink for millennials. So that's it in a nutshell. Those are the 5 inclusions. Now, if you're wondering, what is a granny shot? It refers to a way of an unconventional basketball free throw style popularized by Rick Barry, who made 90% of his shots. As you can see, the typical overhand free throw shots don't have the same win percentage. The way we implement granny shots in your investment portfolio is we look at some critical long-term themes like millennial strategy, global labor suppliers, energy and cybersecurity, and easing financial conditions. And we have tactical portfolios like style tilt, seasonality, and PMI recoveries. But to be a granny shot, you can't just be the strongest stock in one of these 7 themes. You actually have to appear in more than one theme. That's why it's called a granny shot. And the more themes you appear in, the more you are a granny shot. For instance, these are the stocks that appear in the most grannies, or the granniest of the granny shots, which is Google and Meta. That's it for now. But if you want more information, you can get it from our fact sheet, which is available at our website, grannyshots.com.
The 5 stocks are FICO, GE, Robinhood, KLAC, and Monster Beverage Corporation. Now, make sure to do your own personal research and see if these stocks meet your investment thesis. Now, let's take a detour into Bitcoin. This here is an analysis that compares Bitcoin versus gold if you were dollar cost averaging $50 a week from January 18 up until now. The amount invested in each is $19,200. Gold value is $35,821, and Bitcoin value is $142,129. This is why I always say get in before the big bank starts coming in, because there will be a lot of wealth creation being made to the average individual if you can dollar cost average into Bitcoin. That's it for today, folks. Don't forget to like and subscribe to the channel. Don't forget to click the link below for the free community. Thank you for tuning in, and see you next time.